Welcome to Cambridge House Live. I'm Bridget Anderson at the Vancouver Resource Investment Conference, and I'm joined by Rick Rule, who is the chairman of Sprott USA Holdings. Nice to have you here, Rick.
Nice to be here, Bridget.
When you were here in June, you said that there is a strong drift in American politics towards fascism. I thought there's no better place to start today, given that President Obama is being inaugurated, and it is second term. So where do you think things stand today, then?
Unchanged. I didn't see any particular difference myself between the Democrats and the Republicans, and the fact that Obama won over Romney didn't matter much to me. The difficulty I have with the drift in American politics is the fact that America has become so political. The thing that made America work was the opportunity for people to exist and thrive as individuals, and the fact that Americans have become more reliant on the government in the first hand, and in the second instance, more tolerant of government meddling in the economy and in their own private lives, I think is unfortunate, and I think it's the author of, rather than the solution to, the problems that we face as a nation today.
So let's talk about that meddling that you're seeing. What are you expecting to see from President Obama in his second term? Can we expect any kind of backing away from the central bank's interference?
No. The central bank interference in the economy, or what is politely called quantitative easing, is really counterfeiting. Two things are happening. They are mistaking a liquidity issue, that is, we owe too much money, for a solvency issue. They've put cash into a system that has a problem with solvency. That's one problem. The second thing is that as a consequence of that, they can't sell all their paper. We are spending more money in the United States than we either raise or can borrow. So what they do is they create bonds which they buy themselves. If you and I did that, Bridget, that would be called counterfeiting. When they do it, it's called quantitative easing.
So how do you think this is going to play out then?
I don't know. I'm not an economist. I'm a lender, but I don't think it has a happy ending. The idea, as an example, that is in common circulation now, that Greece, which couldn't sustain debt at 150% of GDP, is somehow more solvent now that they own 165% of GDP, isn't a type of mathematics that I learned when I was in school. And in the United States, with on-balance sheet debt of $15 trillion and off-balance sheet debt of $65 trillion, the idea that we solve that problem by adding $1.5 trillion in obligations every year just doesn't make any sense to me. I don't know how it plays out. I'm afraid that both of us are young enough that we're going to find out, which I think is unfortunate.
And so for investors then, how do they then approach their portfolios, and how do they make their decisions when they see this kind of situation rolling out in the US and globally as well?
A couple answers to that question. The private economy in the US is still stronger than people think. There's about $7 trillion in current assets in corporate and individual hands. So there's a lot of money to be deployed. At the same time, we have these structural problems. Think of two big weather systems colliding. And when two big weather systems collide, what normally happens is volatility. The markets have been non-volatile as a consequence of the liquidity that's been pumped into the system by the Fed. I think this is the calm before the storm. I think we will see volatility. I think that investors have to do two things, both painful. One is that investors have to own bullion. They have to own bullion. They have to own something that's a medium of exchange without being somebody else's liability. And they have to own a currency, bullion, that doesn't have a political constituency that's in favor of devaluation. The second thing that you have to do, which might be harder for some people, is you have to have cash. You have to have cash despite the fact that real interest rates are negative. The reason that you have to have cash is that if we have a precipitous decline in the markets, like we had in 2008, the cash will give you both the means and the courage to take advantage of the mistakes of others. So you have to arm yourself at one point in time with bullion, if you will, as currency insurance, at the same time that you have the same currency that you're insuring against the failure of, to take advantage of a market failing. A very, very interesting time that we're heading into.
It's a fascinating time. So where do you see gold going then?
Unfortunately, I see it going higher. Unfortunately, I'm a consistent buyer of gold, and I'll continue to buy gold. I enjoy the fact that the gold price hasn't run up too much because I have some more to buy. But despite the fact that I'm 60, I suspect when I'm 90, what my hope will be is that the gold price hasn't gone up. I own gold as catastrophe insurance. There's no insurance that I own that I'm desperate to get paid on. Life insurance means somebody died. If the gold price goes crazy, it means that we experience that catastrophe. It means that your lifestyle changes. And my life is already pretty good, as I suspect yours is.
So where else do you see capital moving then? You were talking about capital moving out of bonds. So talk to me where you see that heading in 2013.
Hasn't happened yet. My capital has certainly moved out of bonds. Jim Grant famously described the U.S. long treasury as return-free risk. Return-free risk doesn't sound like a very good deal to me. I see the resource space as pretty attractive. It's attractive to me, first of all, because I spent 30 years at it and I understand how to do it as opposed to some other sectors. But I also see it being attractive as a consequence of very, very, very powerful demographic trends. We talked before the cameras were rolling about the fact that emerging markets are becoming slightly more free and much more rich. And as poor people get rich, they use more stuff. They have more calories in their diet. Their life becomes more energy intensive. So the resource bull market is very much intact. And conveniently, this resource bull market coincides with a bear market in resource equities, which means that companies that are becoming more valuable are becoming less expensive. That seems to me to be a wonderful conjunction of circumstance for speculators.
Rick, are you concerned at all that China is running out of steam and they're not going to have that demand for some of the resources?
If you've been in the business as long as I am, you're concerned about everything. I read that people are discouraged about the fact that China will grow at 6.5% or 7% this year. What people forget is that growing a big economy at 7% generates a lot more growth than growing a small economy, which they had 15 years ago, at 10%. You're growing at a smaller rate from a bigger base. The gross growth is much larger. What concerns me about China is the fact that it's still a command and control economy. As political as the United States is, which is awful, China is more political. In China, 10,000 people try and direct an economy of 1.1 billion people. So if I had a nervousness about China, it wouldn't have anything to do with the industriousness of the Chinese people. It would have to do with the friction involved in 10,000 people trying to run the lives of 1.1 billion people. And the possibility, not the probability, but the possibility of the replay of Tiananmen Square as those 10,000 made their inevitable mistake.
So what about other emerging markets? Let's talk about India, because there's a fair amount of thought that, even if China is running out of steam a little bit to 6 or 7% growth, that India is starting to pick up some of that pace.
Absolutely. If you saw India grow at 3%, if you compare it with 15 years ago, the so-called Hindu rate of growth, which was negative, as a consequence of lethargy and administration, that's a spectacular thing. But you don't even need to look that far. Mexico, despite its problems, Chile, Indonesia. I'm just back from Thailand. Around the world, the Middle East, you see people becoming gradually more free in fits and starts. And as people become gradually more free, they become rapidly more rich. If you think back 30 years ago, Deng Xiaoping said to become rich is glorious. And in 30 years, Chinese GDP per capita went from $500, less than $500 to $5,000. And this is happening around the world, in fits and starts, to be sure. What's happening in Syria, as an example, isn't pretty, but it's evidence of a trend. People in emerging markets want to take back more control of their life and leave less to the center, different than us.
So how do you think that trickles down then when you look at some of the junior miners? Is there an opportunity? What is the opportunity to buy for the junior miners then?
Well, the opportunity is, first of all, this is a very nuanced question.
Yes.
The opportunity, first of all, is that one must segregate among the junior miners and take qualitatively only the best 5 or 10%, because 70 or 80% are headed inexorably to their real value, which is zero. The beauty of the junior sector is that the performance that you get out of the top 10% is so spectacular that it adds luster to a really undeserving universe. Going back to the thrust of your question, I think that we are halfway through a 20-year-long secular bull market in resources. We had a 20-year bear market in resources, and in resources, very long bear markets like that, constrain supplies for a long period of time. We need more energy, we need more base metals, we need more food, we need more agricultural minerals, we need all of these things. Most of the juniors will never find any of it, but those that do will be rewarded in such spectacular fashion. that for those people who are willing to do the work to separate from the wheat from the chaff, they will be very, very, very well rewarded.
And it's being able to discern those opportunities. Now, before I let you go, you've been in this game a long time, and not all the years have been successful for you. So what did you learn in the years where you weren't so successful when it came to trading? What lesson was the most important one that you would pass on to others?
The most important single lesson for people to learn right now is that markets work. Bear markets beget bull markets, and bull markets beget bear markets. If you make money by buying low and selling high, you have to love bear markets, because it's only in bear markets that you can buy low. As depressed as you are, all of your competitors are similarly depressed. Buffett teaches that you buy straw hats in winter. You're in winter now. This is not the time to be a seller. Certainly you sell junk, but this is a time to be a net buyer. In 2010, when you felt smart and you were ebullient, that's the time to be a seller. In this business, in resources, you're either a contrarian or a victim. And you can't be a contrarian by being a bull market buyer and a bear market seller.
Thank you very much, Rick. I appreciate it.
Pleasure, Bridget.